Good morning, everybody, and welcome to today's meeting of the Local Pension Committee. This meeting is being broadcast live via YouTube, and it'll also be available for viewing after the meeting. So this morning I've received apologies from Mrs. Wright, Councillor Grundy, and Mr. Pitt and Mr. King. I'd like to welcome Mr. Harrison, who is substituting for Mrs. Wright, and Mrs. Fryer is substituting for Mr. King. So the first item on the agenda is the minutes for the meeting held on the 18th November 2022. I propose that the minutes of the meeting held on the 18th November are taken as read, confirmed and signed. Is everybody in agreement? Thank you. The next item is question time. We've received no questions. The third item is questions asked by members under Standing Orders 7.3 and 7.5. There are none. To advise any items with the chairman that I decided to take as urgent, I have not been notified of any urgent items. So the first substantive item is declarations of interest in respect of items on the agenda. Does any member have any interest they'd like to declare? No. Thank you. So we now come to the LGPS Central update, and this is the first item on today's agenda. It's on pages 21 to 22. Bhulesh, our senior financial analyst, I believe that you are going to introduce, I thought I'd lost you for a minute there, Bhulesh, so I was in a moment of panic, is going to introduce the report. So over to you, Bhulesh.
Thank you, Chair. The purpose of this report is to provide the committee with an update on the fund's pooling of assets into Central. A presentation will be given by Central detailing a number of points listed A to D there. So an update on pooling progress, the Central company update, a client update setting out the fund's holdings and performance, and Central's oversight of underlying managers, how responsible investing is incorporated into ongoing monitoring, and Central's update on their net zero approach and responsible investment goals for 2023. I won't take too long getting through the rest of this cover paper. I want to leave circa 15 to 20 minutes for Central to present and take questions, but just a bit of background. The Leicestershire Fund has invested circa 1.9 billion into Central products as at the 30th September. We also have circa 900 million in low-cost passive pooled investment products with Legal & General. Turnover onto point 5, we've got the 10 funds that we have invested into. Central will run through those as part of their presentation. What you will see, however, is slightly different numbers on their presentation, given we've got a different valuation point. They used the 30th of November, which was the latest available at the time they built their presentation. And they also include commitments made to funds. Rather, our table on this page just shows the valuation as at the 30th of September. That's all I've got.
Thanks very much, Bhulesh. So a warm welcome to Mike Weston, Gordon Ross and Patrick O'Hara and Matthew Jones from LGPS Central, who are with us here today to deliver a presentation. So over to you.
Thank you, Chair. So I was just, Bhulesh has given a very good introduction already, so I won't waste too much time, but Mike will talk us through the first section, which is the update on pooling generally and pooling within the Central area. Gordon, our CIO, will then take us to the investment performance, and then Patrick will pick up on the responsible investment. So Mike, over to you.
Thank you, Chair. Thanks, Matt. Pooling progress across England and Wales. It's on slide 4 of the pack. I could talk forever on pooling progress. I've got 5 minutes to do some headlines, but I'd be very pleased to expand on any of this at any other time, because it's a fundamental subject for all of us at Central and all of you as our owners, shareholders, clients. So slide 4 shows what you would pick up from media headlines about the progress of pooling as at 31st of March 2022. And every year DLUHC has an annual pooling progress update and publishes some of these stats, and the media pour over them. So you can see there, if you look at this chart, LGPS Central is a bit of a laggard on this measure, but it's not a like-for-like measure. If you go on to slide 5, we think this is a more accurate picture, because the biggest levelling factor across the pools to allow an apples. Oh, sorry, can you go back? Angie, sorry, yeah, slide 5. Yeah, so the biggest levelling factor that allows in our view, a genuine apples to apples comparative is how passive allocations are treated. So Bhulesh mentioned earlier on that you've got 900 million with Legal and General external. A number of our partner funds are part of the Seven Shires agreement and have passive with Legal and General, and those are not typically counted in our pooling assets. That, if you don't count that, that's where we get to our 49%. If you roll all that back in, that puts us up there to 81. All the other pools include in their headline numbers their external passive. And we don't have any managerial responsibility for the Legal and General external passive, and most of these other pools don't have any responsibility for those external passives either. So if you look at this slide, I think this gives a very much fairer representation of the degree of pooling. You can look at the dark blue bars, which is the internally controlled assets, where you can see LGPS Central is in the top half, and in the total assets, if you include the passive, you can see that we're second only to Local Pensions Partnership and Northern LGPS, both of which are quite different structures to LGPS Central. So our view is that actually the headlines might not show it, but when you dig deeper, LGPS Central is, amongst the leaders of pooling in England and Wales. I'll come back to some more details about how that impacts LGPS Central in more detail in a minute. But slide 6 just gives some quick headlines about where we are. So around about 30 billion of assets under management. It's forecast to generate 315 million pounds of cost savings by 2033-34. So comfortably above the initial forecast that were done almost 5 years ago now, because we will be celebrating the 5-year anniversary of pooling on the 1st of April this year, which will be a big milestone. I mean, you can see where we've come in those 5 years. 23 investment vehicles, which Gordon will talk about some of those, 79 staff, and also providing some advisory services alongside investment management. So Bhulesh shares with us the Hyman's report on strategic asset allocation, and we just have a discussion about the interpretation that's on that. So it's another pair of eyes to help you as a committee and a scheme. We go on to slide 7. This just lists the 23 funds that Central has launched in those 5 years. So 5 of them are passive equity funds. We've got 8 active funds across equity and fixed income, and 10 private markets funds across the range of private markets assets. And out of those 23, Leicestershire Pension Fund are invested in 11, which puts you amongst the most prolific investors in the Central pool. So thank you very much for the support that you're giving us on that. Conscious of time, my last slide is slide 8, which focuses down pooling onto LGPS Central as a whole. And you can see there that Leicestershire has transitioned the second highest percentage of assets into the pool. We've anonymised all the other pools, but all the other funds, you can probably work out some of who's who. But Leicestershire are the second highest percentage of assets into the pool. So again, thank you for that. There is a spectrum of enthusiasm for pooling. That's not unique to us, not unique to our pool. It applies to other pools, and certainly our spectrum is not as large as that at London Civ, where you might have seen last week that a couple of their funds are actively trying to withdraw from their pool. So that will be a big story for pooling, and we'll keep an eye on how that develops. But that's not where we are in Central. So clearly our objective is to make ourselves as attractive enough to all the partner funds in the pool, so that all those partner funds transition assets, and that increases the scale and increases the cost savings, and everybody benefits from pooling. So at that point I'll stop and let Gordon talk about the investment performance, which is at the heart of everything we do.
Thank you. Thank you, Mike. Thank you, Chair, Committee. Good morning. We should be on slide number 10, please. Thank you. So as you've heard, you're in 11 of the funds we run at Central. On the slide in front of you, you have them really ordered in the active to passive and private markets. As you can see, they all vary in sizes, and the associated contribution percentage to each varies according to your asset allocation, which was obviously derived by your consultants and your strategy. So if I take them individually, again, conscious of time, on the next slide, slide 11, you have the World Equity Climate Multi-Factor Fund. Now, this is a passive fund, so all this does is replicate an index. So you don't expect any outperformance. You expect it to trade or to return performance in line with the index. This climate multi-factor fund was designed to take into certain factors which are identified within various segments of the market, and also to make sure that it has a reduction in fossil fuel reserves. So its profile does two things. It replicates the market, but it is ESG centric as well. As you can see from the returns, we have this thing called tracking error in the top right-hand corner. This green mark means its variation against the index is within a certain percentage. It will never fully represent the index, because the index constituent parts are multiple, and we take a large share of that, but not all. So the tracking error green means it's doing what it should be doing, and it's designed to do. The next slide is the beginning of the active funds. And again, the top row is, as for the next few slides, you'll see is performance. This is the emerging market equity active fund. And as you can see from the fund percentage, it is underperforming its benchmark and target. Now, each fund, both passive and active, has a benchmark which we measure its performance against, but also it has a target, which is an additional value above that benchmark that the fund is designed to perform to. The emerging market fund in this case is underperforming. If you cast your mind back to this year, it's been quite a torrid year for emerging market funds. We started off with Russia in Q1, and it's not got very much better. A lot of people obviously were invested in Russia. Russia, before the their invasion of Ukraine, was a very low debt, very controlled environment, which people thought to be low risk for investments. But not only that, obviously, with the ensuing fuel and oil crisis, it's the reach of it across emerging markets and indeed active markets in the emerged or developed market funds. It also had a lag effect. So you had a lot of effects from this Ukraine and Russia. Add to that the fact that China was shut down again, which is obviously one of the major parts of the emerging market universe. Emerging markets typically have not done very well. This fund had allocations to both, hence the underperformance. As part of this, on the next slide, one of the managers that we chose for this external fund has recently been taken over by another company. And because of this, they have reorganized and changed the way, not only the people in the team, but the way they're running money. We have a very stringent procurement process. Their change to this new manager would not, if we look at their track record, would not even have got through the first stage. So we're having to go out and procure a replacement manager for it to make sure that this fund, which has 3 managers within the fund, is still going to be fit for purpose and will continue to do and attain the results, the performance that the mandate or the fund was designed to do. And as you can see, we're currently in the process of procuring the new manager. It's done under the public sector OG process, and we've just got to the end of the first, which is a standard questionnaire. We've had 50 replies for interested parties to try and replace this. This procurement will carry on probably for much of the first quarter, and we will decide on a replacement manager by the end of that time. So if we go to another, still in the equity markets, but on the next slide, the Global Equity Fund. This is in developed markets, and we have an amber performance here. That means it's outperforming the benchmark, but not the target. And actually, I can sit here today knowing that by the end of December, this is now would be green, because we are outperforming both the benchmark and target. So the performance has improved. It's a 3-manager fund. It's invested in global equity fund in equity markets. Again, it does not replicate the market. It's an actively managed fund, and 2 of the 3 managers have fairly concentrated portfolios of between 40 and 80 stocks, which is against the universes in the hundreds of stocks, is, as I said, very concentrated. So if I take you to the next slide, which is the beginning of the bond markets, the fixed income, the first one here is the corporate investment grade bond. Again, a global actively managed fund. You can see the underperformance, fund has underperformed. And we have 2 managers in this fund, and part of the underperformance was the exposure of one manager into a specific segment of the market, which had a very poor Q3, June to September period, primarily because of not illiquidity in the fund, but the way the markets reacted to the thought of interest rates going up globally and the sensitivity to these exposures. Neuberger Berman and Fidelity are the 2 managers. To date, the fund has improved performance. It is nearly amber, so again, it's nearly is outperforming its benchmark, but not its target as I sit here today in January. The third of the actively managed funds, fixed income funds, is the Emerging Market Bond Fund. Performance has been very good. It's green. It's outperformed both the index and the benchmark. We don't only get concerned about funds that underperform, we get concerned about managers or funds that perform too well, because they're all designed to do a certain, the mandate, the design of the funds is to produce this certain outperformance target. This fund is measured against what's called hard currency emerging markets, which is dollar-based or euro-based issues. But the managers are allowed to go into local based emerging, so Brazilian real, Mexican peso bonds, but also into corporate bonds in those countries. The reason this fund has performed very well is because those 2 segments have outperformed the index, and the managers, by allocating to those 2 segments, have added value. So they're not taking more risks, they're doing it within the parameters of the fund and the guidelines. They're just using their expertise. So again, this is a reason for what is a very pleasing return, but again, not taking additional risk or worrying about it. The last of the fixed income funds is on the next slide, which is a multi-asset credit fund. This, for want of a better word, is a go anywhere fund. The managers here, again, we have 2 managers. They're allowed to go into any segment of the fixed income market, including emerging markets, including government bonds, including corporate bonds. Here, again, we have a red underperformance indication. This fund is measured against cash, and in 2022, basically all fixed income markets were negative in some shape or form. The long end of the gilt market was down about 28%. The less aggressive markets were probably down about 6 or 7%. This the only place to hide is cash. This fund can have a 10% exposure to cash, but other than that, it's designed to invest in the various segments of the market. This is probably the most actively managed of all the fixed income funds, primarily because of their choice of the universe. We chose them for their process. We've chosen the combination of the 2 managers, Western Asset Management, which is the West Coast American fund, and the BMO, or Columbia Threadneedle, as it's now known. We did a lot of mapping of those 2 funds together, those 2 manager styles together, to produce this type of return. So whilst it is underperforming currently, in the last quarter of last year and in March, it's up about 4 or 5%. So the performance is coming around because markets have stabilized. If I take you then onto the next slide, this is just a very brief introduction to our private markets, the private equity primary partnerships of 2018 and 2021. Again, the funds have outperformed. They are benchmarked against the completely standard global equity markets. This is private equity funding. It is less liquid. We do choose the managers, and then below that, the managers will allocate to individual businesses. It has done very well. We are nearly closed on the 2021 allocations. So once we've chosen the managers, we give them we choose them for style and processes and areas that they invest in, and then over time they will find commitments and investments below that. So then the money is committed. So initially the funds are there, but not necessarily committed or invested. It takes about 2 or 3 years for these funds to be invested. The reason you haven't got any performance for the 2021 vintage is because, again, there are very few investments, and at the moment the performance, although it would be mark to market, so there'd be very little performance, but you only have about 20% of the fund that would represent any added value. And on slide 19 is just an overview of the other private market funds that you're allocating to, which is the infrastructure, private credit and property. They obviously are very self-explanatory, but again, investing in the less liquid areas in the private markets, as they're called. And then lastly from me, on slide 20, we were asked just to include what we do for the oversight of managers. Obviously, in the first 5 years, we've been building funds, we've been building mandates and choosing managers to run those mandates. We're getting to the stage that you heard, we're already looking to replace one manager because they've changed ownership, changed their style. So the various teams within the investment department, on a daily basis, a weekly basis, a monthly basis, we'll look at the individual managers, we get reported all their trades, so we can do deep dive diligence on, are they behaving in line with the mandate, are they doing what they should be doing. We have formal meetings monthly and quarterly, and then obviously produce the fact sheets, which I'm sure you will get or at least have access to. And we do all this routine scrutiny on an ongoing basis. If we find something that's either going wrong, they have changed, what could go wrong? Well, they have change of ownership. We've seen that a key person leaves. They have what we see as a different way of, or their process has changed. Those are the major sensitivities we have, because basically we believe that if their philosophy is right, if their process is right, and they have the right people, performance will naturally fall out of that. So we take this part, is the majority of our day jobs to do this. We take this part very seriously in order to identify anything that may go wrong ahead of time before it can actually have a detrimental effect on the funds. And in this time, I will leave it there. Thank you very much.
Thank you very much for that comprehensive report, Gordon. Does anyone have any questions or comments to make? Melise?
The Emerging Markets Equity Active Multi-Manager Fund, you're obviously having problems with it. Is it worth persevering with, changing managers and everything else, or should we be swapping into something else?
It has had, as a segment of investment, it's had a very poor 2022 for China and Russian reasons. There's lots of very good valuations there as the markets settle down. We believe it's probably one of the better opportunities if you're looking at asset classes generally, to invest in at the moment. So yes, I would persevere with it. As I said, we're replacing the manager because the manager, I was not necessarily off the board, but the fact they've changed ownership, and they're not going to go and be running money the way we expected them to or want them to. So we're looking again in the way the markets are split up. Managers have styles, so value stocks, growth stocks within markets. That used to be more the remit within developed markets. That's becoming now more important in emerging markets. So the design of the fund is this new manager will come in with a value sensitivity, and that we believe will get the fund as a unit to perform much better. But as an asset class, we fundamentally believe it is worth investing in.
Declan?
There's a question you mentioned about sort of safe place being cash, but it was limited to the manager at sort of 10%. I just wonder, what's your view on, do we give managers, have we got the balance right, and how much flexibility we give the managers to kind of manage the assets they're responsible for?
The reason for the 10% cash was because we wanted, talking to the design, we wanted to make it a fund for going in multi areas. Do they have enough areas to hide in or protect? In hindsight, it should possibly be larger, but then they also have a 10 or 15% to invest in government bonds. And historically, when you get sell-offs, the government bond and cash allocation would protect you for that type of underperformance. We review, as I'm sure we review these mandates on an ongoing basis, and it's something that potentially we'll look to either give them more freedom or make sure that it is correctly designed. If we go back over the periods of the multi-asset credit sort of allocations as an asset allocation within markets, you have those that are run against absolute return, which basically means capital preservation. They typically would have a much larger cash element, but we did it very much against cash for the allocations to the markets. And historically, okay, the last decade has been a low interest rate. But if you go prior to that, these funds will normally outperform cash plus 3 or 4%, hence the benchmark we chose.
Okay, so Chris.
Yeah. When you ran through all the funds, I mean, also the takeaway was it was a bit of a mixed performance.
Mm-hmm.
You've talked about in the slide up there about how you kind of monitor the underlying managers. I just wondered if there's any kind of reflection on how you choose managers. Do you think that process is working effectively, or is there any lessons you've learned?
We've learned lessons over the whole procurement. So over the last 5 years, the first fund we procured was a global equity fund. And then we've had, as we've developed, as the funds have developed, the tools that we have increased. So we have more ability to do sensitivity analysis and more ability to do this blending, as I referenced in one of the comments. On the LAMAC multi-asset credit fund, we looked at the shortlist of 6. We looked at their sample portfolios. They have to give us that as part of the procurement. And how do they combine? Where's the volatility? Where's the likely outperformance? So we got more sophisticated tools, more ability to do deep dives over this period. So that's how it's developed, and that's good.
Okay, so Dan.
It's very quick. I think my actual question I was going to ask about emerging markets has largely been answered, and so I just wanted to make the comment. It is very good that these things being flagged up and being looked at sort of early stage where there are issues. Obviously, we do need to keep an eye on the emerging market fund as things go forward on that. But it is good it's flagged up and being looked at.
Thank you.
Thank you, Chair. I attended at the end of last year the LGA's Pension Fundamentals training course, and I met a representative, one of the investment managers who was speaking at the training course, and he, you'll be glad to know, favourably referred to one of your other funds called the Global Sustainable Equity Active Targeted Fund. I just wonder whether you could tell us briefly a bit more about that, and whether that is something that you might consider recommending to us, or would it be good for this fund, do you think? Sorry, for this pension fund here. It's not one that we are currently invest in, but it was spoken about favourably by one of the investment managers who was speaking at the training course.
It's that fund has had stellar performance because the world is split up in equity world is split up on one side value stocks, the other side growth stocks. It's been in the last 10 years have been very much of a growth environment. That fund is heavily focused. If the spectrum, that fund would be way up on the growth area. The last 9 months have been the reverse. Your value stocks have come back. Typically, when interest rates go up, a lot of value stocks will be utilities or banks, and they've done far better than some of the sort of high tech stocks like the Alibabas and the Googles of this world. So the performance over the last 9 months has not been nearly so good. But most importantly, if you're either end of that spectrum, your volatility of returns from one year to the next can be very, very high. What we try and as part of an asset allocation, yes, you should be invested in value and growth stocks. What we designed the fund, the Global Active Equity Fund, is to have a blend of value, growth, quality managers or stocks within that, which again should make it a fund for all seasons, if you excuse the bad quote. But it does mean that it doesn't, whatever the market's doing, part of that fund, the value manager may underperform, the growth manager may outperform. The net effect is continuous outperformance. That's what we're trying to design within all these products, not just equity, but fixed income and private markets.
And there is a continuing trend toward things like sustainability and RI&E within funds, and launching the Global Sustainability suite of products was part of Central moving in that, making those products available for clients. So very, very happy for you to be looking at that. I know Bhulesh knows what's going on, but it will be a trend, and it's always nice to get third-party positive referencing. So thank you for sharing that with us.
All right, Nick.
You reference in terms of emerging markets the disastrous investments in Russia. What would happen if, and how would we looking at the risk if China invades Taiwan and how that would affect us? And are we taking enough consideration of that risk?
You might not find it surprising to know that all our managers and internally, that is one of the major risks we have in not just equity markets, but just global markets. It's something that is out there. The markets have learned a lot about liquidity and embargoes and sanctions and everything else. So if I can take the human disaster that would be to one side and just basically look at the fundamental of managing monies around it, people are very sensitive. The Chinese market has reopened to a certain degree. People are looking at. They have a very. They keep changing, for want of a bit of phraseology, they keep changing their mind as to what they want to do. So you have a lot of restrictions domestically. You have the A and B shares, the amounts of liquidity you can do it. So it is something that people are looking at. There is files of what if and what to do. And yes, it's one that possibly the biggest major sensitivity and will continue to be so for a while, just because nobody knows if or when it's going to happen. And God forbid it will ever to happen.
It's good that it's on the agenda because it worries me.
Yeah, I think it worries the markets and everybody, I'm sure.
Yeah, thanks very much, Gordon. Are there any other questions? All right. Oh, okay, please. Thank you.
5 minutes.
That's absolutely fine, Patrick.
Just on the risk monitoring service, just to give you an update on that, it's a very important service for the partner funds. I know they value it. But we made some changes to it this year to make it more reflective of net zero and that sort of way of looking at climate risk. So we added financed emissions in there. This year we also did the scenario analysis, and we were able to add a 1.5 degree scenario into that analysis, which hadn't been possible in the past. We've also responded to the TCFD consultation, so it's clear that there's some more metrics that we need to add to that going forward, and we've already started with that. We're procuring an ESG tool that will give us some additional metrics that will put a bit more context around the raw data that we currently provide to you really in the climate risk reports, and we want to make those more insightful and more streamlined in terms of the length of the document as well. So we're working quite hard on that. And it kind of slots into our net zero strategy, which I'll talk to in a little bit more detail shortly. So in terms of engagement and voting update, we maintained our FRC status and we helped other partner funds who are interested in doing that. Just a Q4 engagement update. We focused on the 4 themes that were agreed with partner funds. They're up for review now. We've done the 3-year period. My personal view is that we need to increase the focus on climate and increase the focus on net zero. And again, our net zero strategy will give us more ammunition to do that, to make that more focused, more precise, and for the reporting around it to be more, again, more insightful and more outcomes focused. So going on to the next slide. And then this is our net zero strategy. So we've developed a dashboard that is going to enable us to monitor the performance of both a company and a portfolio in terms of the net zero trajectory. And we've identified the milestones that we think need to be achieved in order to get to a 50% reduction in scope 1 and 2 emissions by 2030 to get us on track for net zero by 2050. The strategy that underpins that, those milestones, how we measure alignment, is currently with the ExCo at the moment, and once that's been signed off, the meeting's on the 24th of January. That's something that we will share with the partner funds, and again, any assistance required on the evolution and development of a net zero strategy with the partner funds, we're happy to help. Happy to also share this dashboard, and again, this is what we will use to be transparent about our progress towards these targets. Just some key points from the climate risk report. I know some questions arose around that. Just to highlight, total equities carbon intensity dropped by 25% since 2019, and financed emissions decreased by 20%. However, the emerging market equity active multi-manager fund increased in the portfolio's carbon intensity. However, it's still below benchmark. And the carbon intensity of that is largely driven by Taiwan Semiconductor, which is a very large constituent of the benchmark and therefore a very large constituent of the portfolio. But it is a company that is producing essential materials for the transition. The semiconductors are essentially going to be used in everything, including battery technology, for example, or electric vehicles. So kind of that highlights why we want to give you a bit more context in the climate risk report, rather than just looking at the emissions of companies. What actually are they doing, and on what side of the transition potentially is their business model, and comparing them to peers. So that's that one. And then the LGPS Corporate Bond Fund, again, the carbon intensity of that was really driven by the Southern Company, which is a utilities company, naturally a carbon intensive sector. In the context of your portfolio, it's always going to be that sector is always going to be a large contributor to carbon to the carbon footprint whilst it's invested in the portfolio. But there is a transition plan for the Southern Company. They have decommissioned a large number of coal powered fire stations, and they have set targets around the transition, decarbonisation, and their usage of renewable energy. So again, you know, if we compare Southern Company to a peer group, we get a slightly different context. We also ran these portfolios through our Net Zero ZEAL assessment, which looks at the quality of the net zero target set by companies, and the portfolio actually performs quite well through that lens, which is more a forward-looking way of considering these things. And again, that's something that we will try and embrace and encourage in the future, looking at the direction of travel for these companies, as well as where they are at the moment and where they have been in the last couple of years. So looking forward, we've got the launch of the ESG tool. Again, that will enhance the reporting that we can give to you. It'll enable us to look through the portfolios and assess the portfolios in a quantitative way beyond just climate, looking at other social and governance factors that are also material in terms of company performance. We'll continue to develop the team, and we're recruiting at the moment to enhance our stewardship function. And stewardship is going to be a very key part of our net zero strategy, not only with corporates, but overseeing what our managers do. We meet with our managers on a quarterly basis to understand how they're integrating ESG into their investment processes, to challenge them on some of the companies that we think they may have taken overweight, that they have taken overweight positions in, that may have ESG risks associated with them. And we have expectations around stewardship and the engagement and the voting that they undertake, and we expect that to be aligned with our own position on these things. So that's an important thing for 2023, that we continue with the robustness of that challenge. And again, the net zero strategy, I think we've made our commitments. We've worked on how we're going to measure alignment, what metrics we need to do that, what needs to be achieved. We'll have net zero strategies for the individual companies in the portfolio that are going to drive the achievement of our commitments and our targets. And that's going to be the focus of our engagement, and bringing that about and disseminating that to our managers as our expectations in terms of what we expect them to be engaging on and doing as well. Happy to take any questions on that. We'll bring all of that to the table for the usage by partner funds as well. So I think there'll be benefits across the whole of the pool from the development of that work.
Thanks very much, Patrick. Anybody got any questions? Yep, Sue.
Thank you very much, Chair. We've been talking to some extent about the net zero climate strategy. I know that's coming up probably in the next paper. I would agree with the emphasis on being more outcome focused, which I think was the phrase you used, and not only for targets to be set, but actually for performance to be monitored. And I'm wondering what action, if any, might be proposed if it appeared that the targets of the companies that we're looking at were not being met within the timescales that we felt to be acceptable. Thank you.
Yeah, it's quite a topical question, because we've just refreshed our escalation process for engagements and where we take an engagement that's not successful. And there are various tools in the toolkit, including something that we're considering at the moment, which is a litigation that's going on with Shell, led by Client Earth. We're not part of that litigation, but we've been invited for support for it. So that's one area. We obviously, for the active portfolios, we don't manage those in-house. We do have conversations with those managers about how their engagement is going and the scrutiny that we've put them under. And as I think there's a couple of occasions where they have taken a step back and looked at a holding and decided that actually this isn't working, this engagement. We're not comfortable with the risks or the disclosure that management are giving us. So selling out of a company that isn't progressing and isn't cooperating with that engagement is also an option, but that would be done in collaboration with the managers. I also think that at some point in time, we've put some reviewed timeframes into our strategy. We will inevitably have a conversation about what this means for the mandates. I actually think these managers can achieve a 7% reduction in the carbon emissions of these portfolios year on year without a change of benchmark and mandate. I think they should be able to do that without compromising investment return. That's proving not possible. I think that results in a conversation about the mandate. That's obviously something that partner funds be front and centre of that conversation.
Okay, thanks very much, Patrick. Thank you, Sue. Any more questions? No. So thank you very much to Mike, Gordon, Patrick and Matthew for your presentation today. Very comprehensive. We are asked to note this report. Is that agreed? Everybody's agreed. Thank you. So the next item on the agenda is the Responsible Investment Plan. This is item 7, and the report is from pages 23 to 32. Thank you. Thanks, Mike. Thanks. Bye. Just have a brief pause. Okay, so today we've got Kat Toohey, Responsible Investment Analyst, is going to introduce this report. So over to you, Kat.
Thanks, Chair. I think this follows really well on from what Patrick was just saying. Presenting the Responsible Investment Plan for 2023 for your approval. Obviously, members are aware of the term of responsible investment in terms of integrating financially material, environmental, social and corporate governance factors into our investment processes. Obviously, this is integrated as part of both investment decision making and just the day-to-day management and monitoring of investment managers. I know we're a bit pushed for time in terms of strategic asset allocation, but if I just highlight some of the key points. Obviously, we're expecting the net zero climate strategy to be presented at the March committee meeting, hopefully for approval or subject to your approval. That will shape a lot of the actions that are currently within the plan. But I think one of the key things that's new for this plan for this year is the wholesale review of the fund's investment managers. So we're looking to kind of benchmark our managers this year and see what commitments they've made, whether their commitments cover the funds that we're invested in, and also how they manage and measure their climate metrics. We're also, you'll have heard in Patrick's presentation, Central are reviewing their offering in terms of the climate risk report, and we're looking to streamline that for the committee just to make it a bit easier and kind of straightforward to kind of present to you, and just kind of seeing how we can further integrate the net zero climate strategy subject to its approval. I don't think Patrick mentioned it, but on his slide they were highlighting their responsible investment stakeholder day. So 9th of March, all members are encouraged to attend. It'll be via Teams. I know we're expecting a really full interesting agenda, which will kind of talk about responsible investment, net zero and climate, as well as I think there's some stuff to do with human rights. So it'd be really interesting. Really encourage you to attend. But that was basically all I was going to say. We've got some opportunities to kind of consider collaboration on RA matters. But I think officers will just kind of consider that throughout the year in terms of if we want to sign up to the stewardship code or any other kind of bodies that would add value to the fund. But I'll leave it open for questions, Chair.
Thank you very much, Kat. Please.
Just ask one. It's to do with the summit on the 9th of March. I could do the morning, but I can't do the afternoon. And I just wondered, will it be recorded so we can play it back?
I'm not sure it will be recorded, but I can check with Central. It will be via Teams, so you can kind of dip in and out of sessions that may particularly interest you if you can't attend the whole day. But I think that's fine, and we'll send an agenda out, and hopefully with that we can clarify if we can.
If anything interests me in the morning, it'd be lovely. If it interests me in the afternoon, I'm afraid I can't.
Yeah,
yeah, that's
okay.
fine. Thank you.
Jeff.
Thank you, Chair. Yeah, I think I'm just looking at the paragraph 7 in the report, the 4 bullet points there, in terms of the highlights of what's in the plan, really. I mean, it's, you know, the first, second and fourth bullet points is all fine. And I mean, in principle, the third one is as well, in terms of what obviously LGPS Central and yourself have just been talking about, you know, the process of reviewing the reporting side of things. But I think, you know, obviously I'm happy that work is being done in this area, both by LGPS Central and officers here. But I'm just conscious that if the government's new reporting regulations don't actually require pension funds to speedily adopt a tougher reporting regime that actually takes some of these broader issues into account, then I'd be quite worried that we'd end up having polluting companies who are failing to take serious action to transition. And we've obviously heard from LGPS Central there is quite a lot of concern that is the case. Then they'll just stay on our investment books for years, because, you know, the reporting is not you know, explicit enough to actually get us to a point where we can make a decision about whether we really want to stick with them. So, and an example I want to give you again, referring back to the LGA Pension Fundamentals course I went on recently. One of the speakers there, it was from an investment manager, you know, one of the largest investment managers in the LGPS arena, actually, made some pretty, you know, sort of explicit statements really along the lines of, you know, big oil is not a good investment. His view was that BP, for example, cannot pivot its business to renewables quickly enough, and that's a direct quote from what he said actually in a training session. He also mentioned that there are oil and coal companies like Ørsted and RWE who are making that good steps toward transition. So it kind of demonstrates it can be done. So really, I suppose my question really boils down to, you know, do we have any more scope to adopt a tougher reporting regime? You know, for example, one that specifies early adoption of the inclusion of Scope 3 emissions in company and investment manager reporting, and also one that, you know, does encompass a broader assessment of the company's actions towards achieving transition to low carbon. You know, in other words, rather than just monitoring what the company is saying about targets and plans, which, you know, under the current TCFD reporting regime will just enable them to tick the boxes they need to tick under that regime, but it won't actually enable them to be held to account for actually not going through with their actually targets, you know, achieving their targets or actually implementing their plans. So basically, I'm just saying what scope, and I have discussed this with Kat and Bhuvesh in a one-to-one meeting, but I just wanted to, you know, ask that in the context of the committee.
Yeah, so you've had your answer. Presumably, you just wanted to bring it to the note of the committee. Yeah. Okay.
Well, I'd be interested in what the committee, you know, makes of what I'm asking, really.
So you've already dealt with this, Kat, outside the scope of this meeting. So it's
Yeah,
Yeah.
but it's probably worth letting
Yeah,
the committee know.
please do.
It's the TCFD stuff's quite interesting because we've been reporting on TCFD for a number of years where we've not been required to by government, and this government consultation that we've just responded to, that's the first time I think it's being brought to the LGPS and saying you have to report on these measures. We'll have to see what comes out of that in terms of what they say about what we're reporting. I think the fund would always look to report as much as it could. That's one of the reasons why we're doing the benchmarking with managers, kind of to see what they currently record. Do they have, scope 1, 2, 3 emissions, and what other metrics do they measure in terms of the different asset classes? I think that's probably one of the reasons why it's so important to get managers in front of the committee so you can kind of challenge them. It's like Councillor Waddington, challenging Central on, what are you doing with these managers that aren't succeeding in terms of the engagement and those kind of processes. So I think it all kind of ties together, but the fund will always try to, it's better to have as much information as possible. So it's that kind of review on that point 3 is more in terms of how can we get it in front of you in a easily digestible way. It doesn't you don't need a degree to try and understand all the information behind it. But I don't know if that answers all of your points. But also, in terms of alignment engagement, I think that's part of the net zero strategy. Obviously, I can't preempt what the consultation is saying. That's still kind of going out, but we have noted all the comments you've made in terms of strengthening that part about engagement and kind of the alignment of companies. So it's definitely something that's under consideration.
Okay, thanks, Jeff. So your points have been noted. Yeah. So
Can I ask you whether, Jeff, you think this should be brought to the attention of the city and county councils as well as this committee? It's a serious point, and I'm just wondering whether members as a whole across both authorities should be made aware of this the situation that you're focused on.
Yeah, if I may, Chair. Yeah, I mean, I think yes. I mean, it's a big risk, essentially. I mean, and as the administering authority, the county council wants to and does manage its risks. I mean, and it, and this is, this whole sort of area is one of the highest risk items on the pension fund's risk register. So, this was discussed at the last pension committee meeting, you may recall, where actually the committee agreed that this sort of risk around companies failing to, that we invest a lot of money, pension fund money in, are failing to actually transition to a low carbon future. Therefore, potential for those assets to become stranded assets where the pension fund's got a lot of money invested in them, and yet suddenly the value of that investment could just dive. So that is something that I was asking at the last committee meeting, you might recall, for that specific risk around investments suddenly diving in value, and is actually specifically mentioned in the risk register, and I think the meeting did agree. I think certainly it's recorded in the minutes of the meeting last time, agreed that should be done. So, the next time we see the risk register, I'm hoping that those broader risks that do affect, the broader finances within the administering authority, the county council, and indeed all of the councils, because if obviously the investments dive, then it could impact on employer contributions, ultimately, couldn't it? So yeah,
it certainly could. To be honest, Jeff, it's not. It is a risk that we're very aware of, and I think the advisors and everybody's. Declan.
I was just going to remind members really that the key sort of vehicle, I suppose, for us for managing the climate change risk is the net zero climate change strategy, which is coming back to the next committee. To Mr. Bill's point, we have written to all the all the employees in the fund asking to respond to the strategy, and it does set out clearly kind of that balance between managing the performance of the fund for the sort of the benefit of the pensioners and the employers who have to pick up the sort of the cost versus that kind of management of a climate change with the key risks. So to just give you that reassurance that the main employers have been written to more than once asking them to sort of engage with that strategy. And in truth, quite a few of them did when we did the engagement over the summer. So we're trying to sort of promote that quite well.
Thanks very much, Declan. Now, I failed to mention we've got Mr. Clark online. So, Adam, you have a question.
Yeah, thank you, Chair, and very sorry for not being with you. You've probably tell from my voice why I'm not with you. I'm a little concerned that under 29 in the paper, given that we've discussed a session that's coming forward that will discuss human rights implications. We're not given any equality and human rights implications in a paper. We're asked to approve an investment plan within. I think I'll probably know what the answer to that is, but I think it would at least be worth being given an explanation why there aren't deemed to be no equality and human rights implications to this paper. I am concerned also, it's almost the other side of the coin of what Jeff was talking about, in that I think there is an emerging argument that we could be seen to be on equality and human rights, discriminating again in terms of age. I think there's stuff coming forward in Australia around the potential for older scheme members to be given preferential treatment, given the climate argument, against younger scheme members. And I do think we do need some consideration of that. And I'll take this opportunity to remind you, Chair, that I've requested training for the committee from Carbon Tracker. Mark Campanale, who is the chief exec or similar of Carbon Tracker, has offered to give training. He's given to many pension committees on these matters, and I'd like that to be brought forward as a matter of urgency. Thank you, Chair.
Thanks for that. We'll come back to you on the climate tracker. We'll give you a written response on that, Adam. Kat, have you got anything to say about the Declan?
I think it's probably a fair point on the equalities and human rights implications. We should have picked it up. Obviously, the aim of the RI isn't just about, it's the full ESG, environmental, social, and sort of governance as well. So broadly, the plan will be supportive of equality and human rights implications. We'll make sure that in future we do sort of complete those sections.
Chair, I don't know how we can approve a paper then that doesn't include those implications. They're quite fundamental, aren't they?
Well, we've just said we're going to do that.
So we won't be approving this paper today?
We will be approving, hopefully, this paper today. Yeah.
Without those implications?
If there's a specific concern, we could maybe sort of work through. But if we were to put a paragraph in there, it's going to be broadly supportive that the responsible investment in plan, if it will be mindful of equalities and human rights implications, been sort of promote sort of managers have to sort of take heed of them. So it'd be a positive that kind of adds to the members' ability to approve the paper, as opposed to a negative that it's going to cause a load of problems. So, but if there is any specific worries that you've got within the contents of the plan that it does impact people's equalities and human rights implications, we could maybe try and work through that.
Okay, thanks very much. Any other questions? No other questions. So we are asked to approve the responsible investment plan. Is that agreed? Agreed. Yep, that is agreed. Thanks very much. The next item is we're going on to the pension fund training update. That's on pages 33 to 43. Declan is going to present this report. So over to you, Declan.
Thank you, Chair. It's obviously very important to have adequate training when this committee is responsible for something as important as people's pensions and the costs that could fall onto employers if that management isn't adequate. And it's an area that regulators have become increasingly focused on.
And it's kind of, and it, just a reminder to members, it does set it out in the report that it is a requirement, or sort of participation in training is a requirement for sort of membership of the board and committee, because of, like I say, the paper does lay it out and regulators are pushing even more on it, that sort of adequate sort of training. And a key element of this sort of being able to organise the training over the sort of course of the year is that sort of training needs assessment that's been circulated. At the moment, we've got 8 out of the 12, sorry, 8 of the committee members have done it. So if I can sort of urge any members who haven't done the training self-assessment yet to sort of complete that as soon as possible, just so we can look at what the training plan over the course of the year is. Paragraph 8 of the report sets out the different types of training. We're likely to continue to sort of mainly sort of focusing on the sort of the Hyman's online training, but also the kind of the training around the pension sort of meetings. And the reason we favour those two sort of streams is it kind of gives that sort of just in time kind of, you're getting the infusion of knowledge, as it were, at the time when you need to sort of apply that knowledge. So they're still likely to be the ones that we focus on. And for the Hyman's one in particular, the sort of the take-up's been a bit mixed. So if I can urge, again, committee members to do sort of modules 1 and 2 as soon as possible, as soon as possible, just because it does sort of set out the role of the committee and sort of your sort of, I suppose, part of that role as well of the committee. So it's just really important that we get sort of those bedrock ones done as sort of soon as possible. If you do have any specific training requests that are not being picked up by the sort of the general training we do put on, please do raise it with one of the funds officers, and we'll see what we can do. The report's just for noting. Happy to take any sort of comments or questions.
Thanks very much, Declan. I think everybody's probably had the email to complete the training needs assessment that's been sent out, and I think the points Declan makes, if the Hyman's training modules 1 and 2 worth looking at, definitely. So, does anybody have any questions?
I don't know if there is an answer to this, but the thing the ticker box, I have no knowledge. I have some but limited knowledge. I'm reasonably familiar with training, be helpful. I'm fully conversant. I would never dare say I'm fully conversant. And I've always got a little bit of knowledge. So I wonder if the 2 and the 3 couldn't somehow be worded slightly differently to reflect. I just ticked 3 the whole way down because I thought, I don't know.
Yeah. No, to be honest, please, I agree with you totally. I think it would be a very brave man who said fully converted with everybody else. So it's good.
When I was thinking of a question, I thought, well, what can I recommend? And I can't think of an answer, but there could be something.
Well, look, we'll have a play around and we can do. Maybe we do something around kind of. I've had a good training. I'd like more training, something on that line. So maybe what you need is.
I think that would be helpful because, I very much take your point. Mr. Lombardo.
Thank you, Chair. I was just going to say, I think based on the conversations that are taking place and becoming more prominent and almost embedded in every conversation about responsible investment, ESG, etc., I think something which I certainly would benefit from, and I think we all would do, is training around responsible investment, in particular around reporting and how we as committee members can probably zone into those kind of issues in a lot quicker. I think Councillor Adam mentioned something around those lines, but whether it's specifically something, I think we would all benefit from that. And it seems like it's moving very quickly at pace, and we're having to make decisions.
I think it is. I mean, there's the conference on the 9th of March, I think it is, which will certainly give us all a bit of training if we can get there. But I take your point. Yeah, I mean, that's an all-day session, so that's hopefully we'll all be a lot wiser after that. Jeff?
Yes, I think that I totally agree with you actually on that, and I'm hoping that summit will also help us on that. But I just wanted to say, having done both the Hyman to Robertson online training and and then weighing up whether I actually needed to do the LGA pensions fundamentals training, and then deciding to go. I actually felt it was a really good course, the LGA one. It obviously helped it was in person as well, but there is an online option with that one if you don't want to travel to Birmingham. But I would recommend the pension fundamentals training.
That's the LGA pension fund training. Yeah,
it was very good.
That's great. Thank you. Sue?
Just a quick point about the training on responsible investment. You've just told us we're going to learn more on the 9th of March. But unfortunately, that is after the timetabled agreement for the timetable committee to agree the strategy. And I wonder whether that timetable might be adjusted, because if we're going to learn more on the 9th of March, our views on what we've got to agree on the 3rd of March might have changed a bit.
To be honest, I think that given the information we've had already, we've all got our own views on climate change, and it isn't then something that's going to go away. It's going to be a focus going forward forever. So even if it is after the 3rd of March, I think it's invaluable, and the amount of information we've had is quite considerable. We've certainly got enough to form our views. Declan.
I was just going to say, similar to Chair in Truth, it's just a massively evolving area, and I know Jeff previously touched on sort of the government guidance. So it's going to be one of these areas that no matter how long we wait, there's always going to be something kind of the next month, the next quarter. So I think it's important that we kind of get a strategy in place as soon as possible. We can start to work and develop from that. But I suppose to your point, we do keep to continually refresh that and monitor, has things changed that we need to do it. So there is a commitment that every year we'll kind of, we're going to monitor our kind of our progress against targets, but we'll also monitor what's happening in the external environment as well, in terms of, how quickly or sort of slowly we're moving and how much we're sort of pushing managers to develop reporting. So I suppose to give you assurance, it's not just a strategy. Once it's done, it puts on the shelf, but it should be sort of a live document as well.
Yeah, I'd endorse that. We're all learning the whole time on increasing our knowledge, but it's important that we do. Right, are there any other questions, Mr. Bill?
A note about 9th of March, picking up Melissa's point, I've looked up my diary as well, and we've got highways in the morning and afternoon on that day. So whether we're going to be able to slot in and out.
Oh, you are going to be able to slot in and out. And I think I'm not quite sure. I didn't pick up whether it's going to be recorded and available for watching later.
Well, I'll follow up after with Central, but you can drop in and out on the sessions if you can't attend the whole time, because it'll just be via Teams. But I'll follow up with Central, and I'll probably ask that they can see if they can record it.
That'd be really helpful. Thanks, Kat. That's it. So any other questions? So we asked to note the report. Is that agreed? Yeah, that's all agreed. Thank you. So on to the next, which is item 9, the overview of the current asset strategy and proposed 2023 asset strategy. We have Philip Howard-Check from Hyman's present to answer any questions. But firstly, I'm going to hand over to Bhulesh to present this report.
Thank you, Chair. Very quickly then, so we've got 2 reports on this. The first here is an overview on the proposed strategy for 2023 and a quick review of what happened last year. Like the Chair says, Hyman's will also present during the private session as well. Just moving over to point 6, and point 6 is quite important, so I'll read it out. Any decision on the appropriate investment allocation is inherently difficult and will inevitably come down to a trade-off between risk and return. Whilst historic measures for risk and return can be instructive about how different asset classes are correlated to each other, they clearly give no guarantees that these historic links will persist, and as a result, an optimal asset mix doesn't exist. 2022 was a reminder of this, as previously held beliefs were not proven to be the case, as both bonds and equities sold off. The table below point 6 gives a quick summary of last year's actions and some progresses. So you'll note we've got 5 points there. The first is the listed equity review from last year, which has been rolled over to this year. And there's a number of reasons for that, which are included within the actions box there. The property review to restructure the current portfolio was completed at the April ISC last year. And we've made commitments to funds with Central for that. The infrastructure review was completed shortly thereafter in the July ISC. We've since allocated to a couple of funds there, Quinbrook, you may remember the Net Zero Fund, and Stafford, who manage timberland assets. The targeted return review, which was planned for 2022, we did start work on that. Again, we've delayed that into 2023 whilst the product was being delivered. And the review of distressed debt, which we expanded later in the year to include all private debt, was completed, and then we made a number of multi-year commitments as during the ISC in October. Quick overview of 2023's proposal. So like in previous years, you've got a table here. point 10, which highlights where we're planning to go to. So we've got the September 2022 actual allocations, the current SAA, which was the 2022 SAA, and the proposed SAA. There are 6 changes of note in there, and they are literally the first 6 that appear on there. So you'll note that we're proposing to reduce listed equities by 4.5%. We're proposing to increase private equity by 1.75%, and reduce targeted return by 2.5%. Those changes there largely flow into the income assets, which are the next 3 there. You'll note that we've got an increase in infrastructure allocation proposed and an increase in liquid sub-investment grade debt. Those 2 there. There's a minor change at the bottom there, that which, you know, I'll take questions if needed, but it's only a 1/4 point. The mechanics on how those changes will be enacted are included later in the agenda. I don't propose to talk any more about those. I think that, you know, if you look at points 20 to 22 and onwards, it's an expansion of the table effectively. So there's some added detail there. It's probably a good point to take any questions at this point. Otherwise, we can move to the next point on the agenda.
Okay, at this stage, has anybody any questions or queries on it? Comments? No? All right, so over to Philip and Abhishek for your input. Okay, that's fine. Okay, so we're going to go into private session in a minute. So the date of the next meeting is the 3rd of March 2023 at 9:30. There are no urgent items to take, so we're now going to go into private section. The public are likely to be excluded during consideration of the remaining items in accordance with Section 100A, subsection 4 of the Local Government Act 1972 exempt information. We now move into private session for consideration of the remaining items. Please could I ask people in the public gallery to leave the meeting? We have no people in the public gallery, so nobody's